Imagine you have 100,000 invested in an S&P 500 fund. Then the AI boom begins to fall apart. Companies cut back on data center spending. AI revenue comes in below expectations, and the stocks that benefited most from the excitement start dropping. What happens to your money? The S&P 500 owns around 500 large U.S. companies, so it sounds like one struggling trend should not matter that much. But the index does not divide your money evenly. It is weighted by company size. The larger a company becomes, the more influence it has on the index. A drop in a few enormous companies can move the S&P 500 more than dozens of smaller companies moving the other way. And several of the largest companies are closely connected to AI. NVIDIA sells the chips. Microsoft, Amazon, and Alphabet operate major cloud platforms. Meta is spending heavily on AI infrastructure. Broadcom helps supply the technology behind data centers. So the first question is how exposed the S&P 500 really is. Information technology alone represents roughly a third of the index, but that does not include every company tied to AI. Amazon is classified as consumer discretionary, while Alphabet and Meta sit in communication services. There is no clean percentage that tells us exactly how much of the S&P 500 is an AI investment. But the largest companies have a much bigger effect than the phrase 500 companies makes it sound. Now suppose AI stocks begin falling. Maybe businesses are not adopting the technology as quickly as expected. Maybe the companies building data centers are spending more than they earn from AI. Or investors simply decide the stocks became too expensive. There is no exact number for how far the S&P 500 would fall. A sell-off could stay mostly concentrated in chip makers, cloud providers, and the companies most closely tied to the AI build-out. But if spending cuts began affecting data centers, utilities, industrial suppliers, and the wider economy, the damage could spread well beyond technology. The result would depend on whether investors were questioning a few expensive stocks or losing confidence in the entire AI investment cycle. So even someone who never bought an AI stock directly could still feel the impact through an S&P 500 fund. But that does not mean the S&P 500 disappears. The index would still own banks, healthcare companies, industrial businesses, energy producers, consumer brands, utilities, and hundreds of other companies. The large technology companies would also still have businesses outside AI. Microsoft would still sell software and cloud services. Alphabet would still have search, YouTube, and advertising. Amazon would still have retail, logistics, subscriptions, and cloud computing. An AI slowdown could reduce their growth and lower their stock prices without making the entire businesses worthless. The S&P 500 also changes over time. As a company falls in value, it receives a smaller weight. As another company grows, it receives a larger one. Companies can eventually be added or removed. Owning the index means you are not permanently locked into today's winners at today's exact sizes. So should an investor change anything before the AI bubble bursts? That depends on the rest of the portfolio. Someone who owns only an S&P 500 fund may decide the concentration is acceptable. They still own hundreds of companies and may have enough time to wait through a major decline. But someone else may own an S&P 500 fund, a NASDAQ fund, and individual shares of NVIDIA, Microsoft, Amazon, or Meta. That may look diversified because several investments appear on the screen. In reality, the same few companies may appear in nearly every one of them. That investor may have much more AI exposure than they realize. Diversifying could mean adding smaller U.S. companies, international stocks, bonds, or cash based on when the money will be needed. It does not mean selling everything because someone online says a crash is coming and no one knows when a bubble will burst, how deep the decline will be, or how quickly the market might recover. Selling after a major drop also creates a second decision, when to buy back in. The recovery may begin before it feels safe. So what happens to the S&P 500 if the AI bubble bursts? The largest AI-connected companies would probably take the first hit. But the index would still own hundreds of businesses. Its weights would keep adjusting, and many companies tied to AI would still have profitable operations outside it. The biggest risk is not that the S&P 500 goes to zero. It is believing that owning 500 companies automatically means every part of your portfolio has equal influence. The time to understand that concentration is before the market falls, not after your account balance is already dropping.